will be personal finance and tax planning. This is one of the topic which is very important in everybody's life, because when we start our career, we get our first salary, but the day of when we get the first salary, we have to plan how do we manage our money and become a good master of money, right? So we'll start with that. Today I have our host and presenter Amit Etchel. He is the co-founder of at Floater and also the product head. So let's get started. Amit, over to you.
Yeah, hi. Thanks, Mubarak. So, good morning, everyone. My name is Amit. I think you all might have seen the webinar invite where you might have seen my photo. Uh, as Mubarak mentioned, this webinar is first one in the series of regular webinars that we intend to do. And the overall idea of coming up with series is that we are starting into a new financial year, and we have come across many individuals in different age groups where they often have, missing link between how to save, how to invest, how to save taxes, whether they should invest in a particular thing or not, what kind of a tax saving a particular investment will give. So many such queries. So what we are doing is that in this first session, we have kept it very conceptual, and we will not get into too much detail of each of the topics, but it will give you enough understanding of the concept, and based on that you can start basically building upon that knowledge through other different sources also. Plus you can always attend all the following meetings or webinars that we do. So that will be really, maybe after 3-4 sessions, if you attend, you will be getting a much deeper idea about some of these topics. Okay, so just a quick introduction about us as a company. So we are a 2-year-old company here based in Bangalore, and we are a financial services and technology company, which means that we have a technology platform through which what we are trying to do is that become a one-stop solution to help everybody simplify their personal finance. So simplifying personal finance is a very holistic topic in a way, and this webinar is about taking each of those topics individually and understanding how a complete life cycle of personal finance management should look like. A couple of certifications and credibility of our company. So we are a AMFI registered plus PFRDA licensed entity, which means that we are authorized to distribute some of these products from PFRDA AMFI plus some of the other products also. And also we are entitled to conduct this kind of a knowledge sessions, which could be helpful for any individual. Now, the target audience for this webinar is not really any specific age group like 25-30. What we have tried to do is that a lot of these topics are something which many people want to understand a little better. So it will be beneficial for everybody. So quickly, just listing down some of the topics that we'll be talking about. I will not go through it one by one, but you can just 5 seconds, you can go through this, and we'll talk all of this in our following slides. So this will be followed by a question and answer session. So roughly around 15 minutes we'll allocate for that, right? And towards the end, we also have an exclusive offer, which we'll be talking about for all the attendees of this webinar, and detail will be shared towards the end of the presentation. All right, so let's get into the topic of the day, right? So let's start with very conceptually, what exactly is financial planning, right? So we all have different ideas about it, but just to put it in a sentence, how does it look like, right? So this is what it essentially says, that a step-by-step approach to meet one's financial goals, correct? So it's about an approach and a process that is actually required to achieve our financial goals in future, mostly related to me, my family, and maybe some goals I might have for my career also, right? So all of that. So that requires approach which needs to be followed. Now, overall, what it does is that it helps you be on top of your how your expenses are and how you save, how you invest. Correct? So, because you have created a process, you have documented, or even if not documented formally, but you have figured out that this is the things I'll do and these are the things I should not do. So, you will be in a better position to take any corrective decision, right, if it is required in the next uh, uh, period before you reach your financial goals. So these are the three high level, I mean, concept wise, this is what financial planning is. It's an approach and a process that we should follow. Now let's talk about, we earn some income either through salary or um, a lot of times we have any other incomes like rental income, business income, correct? Somebody might have pension income. So the first thing is like, what are the choices in front of us? Not many, I think. We have just three choices, right? We either spend it or we save, and if we are saving, then investment comes into picture, right? So this is how we make choices for our earnings. Now, we'll start with a very famous quote by one of the richest person in this world, richest individuals in this world, Warren Buffett. And this is a very strong statement which some of you might have heard of, right? That when we have money, we should first think about saving before we think about spending, right? What it does is that it helps us in the best possible way to ensure our savings are not compromised, right? And once we have saving done, we know how much money I have to spend, right? So we should all follow this practice. Maybe some of us do it in some way, but a more structured approach will be more beneficial for any individuals. So we talked about spending, right? So spending is straightforward. I think there one approach is required, that let's plan how we want to spend, and we should monitor, track it on a regular basis. May not be on a daily basis, but at least maybe weekly, or worst case monthly for sure we should track. Now let's talk more on the saving side, right? So we understood that we'll first save and then spend. Now, is saving enough? Correct? Because we have to see what could be the outcome if we keep savings. So we all know about inflation. We all know about how cost of each and every product and service has been going up over the years, right? So I think we all remember at least 5 to 10 years back what kind of a cost a particular product had and now what the cost is. So inflation plays a role, right? Now, let's have a more data-oriented understanding of how inflation impacts someone's expense or savings. We'll look at both of them. So on the expense, if we see, so what we have done is today my expenses are 30,000. Now, if we talk about that, I keep having the similar level of expense for my household, then not doing anything also in 5 years, I'll have to spend 40,000 to do the same amount of activities, same amount of expenses, right? And in 20 years, this could be roughly around 3 times. So which means that value of money is going down, correct? Similarly, if we look at savings, similar thing happens, right? That today, if I have 1 lakh rupees, which is with me either as cash or maybe in some savings bank account which does not give enough interest. So what will happen is that this 1 lakh will be worth only 80,000 after 5 years and just about 1/3 after 20 years, right? So both these examples are only to say that the value of money keeps going down, right? That is the impact of 5% of yearly inflation in this example. So this tells us that if we only save and do not earn enough interest, then our value of money will keep going down, and when we need it, that may not be enough. right? So what is the safeguard for it? Safeguard in the sense, if savings are not enough, then what should be done? What should be done so that inflation does not affect my future goals, right? And that's where investment comes as a solution. So if we have the right investment strategy and plan, we can tackle those inflation impact, right? And by the way, the inflation is not uniform across every product and service. What 5%, 6% we keep hearing is more of average inflation that government announces every year, or I mean, actually it is every month, quarter. But if you see any specific thing, for example, cost of becoming an engineer, or cost of doing an MBA, their inflation might be even 10% in some cases, right? But we always have to play around with some average. But for a specific goal, we can look at different inflation figure also. So what are the things that comes in investment? So I said this is a safeguard, right? So what exactly it does? So we'll put our money to work. Means my money should earn more money for us, correct? And that's what investment means. It will grow over time, and we also should invest in a way that this interest that I will earn should be more than the average inflation rate, so that I can accumulate funds which will be uh, enough for achieving that financial goals. Now, another important thing is that we should start early. Early in the sense, there is no specific age when one should start investing. However, as soon as you know about this concept, you should start, right? So the earliest probably somebody can start is when they are getting into the first job. Maybe before that, they may not be having the money to invest, right? But then as soon as we get our first salary, thought should be to invest whatever small amount, right? Now let's see the impact of starting early. So there is a strong financial concept called power of compounding. So what exactly is power of compounding? In a layman's language, it is earning interest over interest, right? Which means if I am investing 100 rupees for 2 years at 10% interest rate, then end of first year, my interest will be 10 rupees and principal was 100 rupees. So end of 1 year, I have 110 rupees in the bank. In the next year, I will earn interest on 100 also and on 10 also. So my next year interest will be 11 rupees. So this is how compounding keeps happening when period is long. In an example way, we will see it, right? So this is a maturity amount at the age of 60, that a person who starts investing 22,000 rupees every month, and he will increase his investment by 10% every year, right? This is an assumption. Now, if you see the person who is 22 years old today, his maturity amount will be 4.7 crore. But if somebody starts at the age of 35, same 2000 rupees, then his maturity at the age of 60 will be only 78 lakhs. So what does it signify, right? We'll look at that. Similarly, a reverse example. Here what's happening? I am setting a target of 5 crore, right? When I am 60 years old. So now what I'm saying is that how much I should start investing today. So again, in a similar way, just a reverse, that someone who is 22 years old, he can only start with 2,200 rupees to achieve 5 crore of target. But somebody who is 35 will have to invest almost 6 times of the first person who is 22, which says that starting early has its massive advantage over a period of time, correct? And hence I said in the beginning, best time to start investing is right now. It doesn't matter if you are 30, 22 or 50. If you have realized it today, you should start investing, right? That will give a lot of benefits in a long term. Now, we learned about investing. Now, everything has to start somewhere, correct? And this is where a plan is very important here. We should not start investing just because we thought some wild idea, or we heard from my friend, or maybe in a business news channel that invest in that stock or invest in FD or see some advertisement of insurance, right? So many things we keep coming across these days. But before choosing any of those, having a plan is very important, right? What a plan means, right? What is the outcome from this plan that we are looking at? It's very simple. We call it 2W. One is why, second is when. Why means why I am investing, right? That means what is the goal I am trying to achieve, right? What is the goal? What is the amount? For what purpose? All that comes under why. Timeline is very important again, because a goal plan is incomplete if you have not assigned a timeline to it. So timeline is very important, right? That means if I am thinking that I'll buy a car of 10 lakhs rupees and I don't tell about when I want to buy, then that's not a goal plan. I should clearly say after 5 years, I plan to buy a car worth 10 lakhs rupees, right? Now that works, that becomes a goal plan. So what are the other specific benefits, right? So it ensures that I know how to execute it. So we'll know about the action plan, right? Now it will also help me to create a strategy for how to invest and where to invest. Because these are two very important things. And this is where you will not be able to do if you don't plan and start it. Now, while doing the planning, you will also understand that if you have listed down, let's say, 6 goals, you will know which goal is more critical for you and your family, and you will prioritize it accordingly. Correct? Maybe you will allocate more saving toward that. And obviously, any goal, again, if it is not measured, then you're not executing it in the right way. So execution has to be with progress and measurement of that progress. That means tracking your goal, whether you are on track. So if you track it, you will be able to take corrective decision whenever it is required. So how does a sample goal plan looks like, right? So I told about why and when, right? So if you see here, both are there. So a typical plan for most of us might be like this. Maybe starting a business may not be a goal for all of us, but somebody may have it. But rest all are almost common that all of us plan for. Or if we don't plan for, we still have these goals. First one could be emergency, which means I should have some money available at any point of time to withdraw immediately and use it, right? So typically it says 3 months of expenses should always be ready with you, right? Which can be withdrawn within a day, right? So that is one of the most important goals somebody should start with. Others are very self-explanatory. If somebody wants to buy a house after 10 years, or maybe kids education after 15 years, marriage after 20 years. So these are standard family goals, but the other most important goal is retirement, because that is the most ignored goals in our country, right? And there are many surveys which says that 87% of people who are retired today do not have sufficient amount of money to manage their post-retirement. So this is very important for all of us if we are still working, that we do a very, very serious planning of retirement and try to achieve it over a period of time. Correct. So this is how the goal plan looks like, and as I said, it basically helps us get a defined timeline for each and every target amount, whatever financial milestone I might have. Now, plan is done, and that planning will give you the strategy, or the next step of the planning is the strategy making. Now, there are three most, or I would say four most important things that one should look for while making a strategy, right? One is that first know about yourself, that how much risk you can take, correct? Which means that if somebody says that I should invest in fixed deposit, and I feel yes, I always want to invest in fixed deposit, I cannot take any risk, which means I should not invest in risky assets, because if I invest and tomorrow if I see slightly negative returns, I might panic and withdraw my money, which is even more dangerous. because withdrawing money when the market is going down is more dangerous because you are actually booking your loss. So that is the reason we should do this understanding and analysis of our own capability beforehand. This will help me decide where to invest, where not to invest. Second is liquidity requirement. What is liquidity? Liquidity is simple. Availability of cash. That is liquidity. Means if I have invested somewhere, how fast I can encash it if required. Right? So as we know, when we keep cash in our locker, that is the most liquid fund because I can go and pick it anytime, maybe within 10 minutes. Second can be savings account. That is also almost similar to cash because I can go to any ATM and withdraw it, or even if payment is to be done, I can do it through UPI and stuff like that, right? Similarly, every investment has different kind of liquidity. For example, PPF. PPF, we all know for 15 years we cannot withdraw, right? I mean, we can withdraw, but there are a lot of limitations, which means that PPF is not a liquid asset. So we should decide about it because based on this only we should start investing, and we will get to know about it when we do the goal planning, right? Because as I said, when we do emergency goal planning, that must be liquid because I might need in emergency, right? When I'm planning for retirement, I don't need liquidity because I'll retire maybe after 10 years, 30 years. So I don't need liquidity for retirement goal. So this is how you should analyze it. And then comes investment decision, right? Once you have done your risk profiling, if you have understood your liquidity requirement, then you will be able to decide where to invest, how to choose your investment options. There are many, okay? But before that, you should know where to invest, right? And the last point, most important, please consider the taxability aspect also, right? Because a lot of investments give you tax exemption when you invest, a lot of them they don't give you. Second thing is that many investments don't charge you long-term capital gain tax, but there are most which has long-term capital gain tax also. Now, if you can understand, if there is a long-term capital gain tax of let's say 10%, which means if you have planned for a goal of 30 lakhs, you rather invest in a way that your actual corpus becomes 33 lakhs, so that after paying 10% of tax, you have the required goal amount. And this is where tax assessment and tax aspect analysis is important. All right, so we talked about diversification of investment. So let's look at what are the most well-known in asset classes where we invest or we can invest. So first three is probably well-known. These three are well-known, I think. So I have just categorized it based on how much risk is there in that investment and what is the liquidity. Liquidity in the sense how fast you can encash it. So and what is the interest rate you can expect in those kind of asset classes. So fixed return, we all know FD is fixed return, PPF is fixed return, PF is fixed return. However, it's a different matter that this fixed return keeps changing every year, right? For especially for PF and PPF. But for FD at least, once you have deposited, that fixed return becomes fixed for you at least, right? And typical average return you can expect is 5 to 8%. Now next comes gold and silver. I think this is the most favored investment for India, all of us, especially the female population of our country, right? We tend to invest a lot in gold and silver, and there is a reason for that, right? Because the history says that the value of gold goes over time, right? And if you see the last 20 years history, it has given in the range of 10 to 12% return, the gold, right? But yeah, I mean, it may not be always 10 to 12, but on average 7 to 10%, right? Liquidity is again high because you can go to any jeweler shop and sell it, right? Risk is also kind of low. Mutual fund, again, interest rate you might get higher here, but at the same time, it has some risk between low to high because there are different type of mutual funds. Each of them has different kind of risk. And liquidity again is very high because you can sell it in live market Monday to Friday. You can sell it, and your money will come within 1 to 2 days, right? Sometimes 3 days. Next three are stock market. Stock market, again, probably the highest risk involved, but at the same time, because the risk is always directly proportional to your returns potential. Means high risk may give you high return, but at the same time, you should be prepared for negative also. Correct? And this is where the risk comes. So stock market is, one is it's risky. Second is it is not for everybody if we don't understand why we are doing it. And again, liquidity is high. You can sell in live market. NPS is, I think, again specific for retirement planning. And good thing is that this is highly regulated product by Government of India. It's, I think, almost 14 years old now for all citizen. And for government sector, it was launched in 2004. Now here the returns are potentially high returns, but this is also market linked. So there is some low to moderate risk is also there. Liquidity is very low because this is locked for 10 years or till the age of 60 years. Property, uh, quite favorite among us, but liquidity is very, very bad because you cannot buy and sell a property so easily. And returns can be sometime high, sometime moderate. So we learned about what are the investment diversification option I have. So I have made my plan. I have started investing by choosing the right kind of a portfolio. Now, next one very important thing is that do we know if these goals are going to be achieved in any scenario? Any scenario means there are two specific scenarios which can actually derail our financial goals and whatever investment I am doing. Correct? First one is medical emergency, especially when high medical expenses are to be borne. Right? It can be in our family or in our close family for whom maybe we have to fund. Right? And second one is the most unfortunate one if the earning member only is no more. Now, in both the cases, especially let's look at the first case, right? In medical emergency, what happens? If I don't have, let's say, 5 lakhs rupees for a surgery, what will I do? Maybe I'll go and withdraw the money which I had actually started saving for my kids' education, right? Because now medical emergency is more important for me and I cannot ignore it. But what happened? I compromised on my kids' education goal. And if the earning member dies, then of course the full family might start struggling because nobody is now going to invest for that all the goals which was created for the family. Right? So we must protect ourselves from these two very important risks in life. And there are very low cost, simple products available in market. Right? One is called medical insurance, which a lot of companies offer you, right? Even in public or private sector. But it always good to have one of our own, right? And there are a lot of benefits to that, which is slightly out of scope for this discussion. Maybe we can take up more detail about all that in one of our following sessions. Life insurance, again, one thing I'll tell you here. Okay, next slide, I'll talk about it. So now let's look at what to look for in an insurance, right? At a very high level, I would say. So when I'm talking about medical insurance, 4 important things I should look for. One is we should know what is the network of hospitals covered by my policy and my insurance company, right? Because it must have the best hospital in my city or whichever city we think I will approach in case of medical emergency, right? Coverage should be across India so that I can go and get treatment anywhere in the country, not worried about expenses. And there is something called sublimits and co-payment, which means company will not pay full amount of your medical cost. So we should avoid buying such policies. And of course, we should also look at what is the history of claim settlement for the company. Because if company has very bad history of claim settlement, which means that if I file a claim of 5 lakhs, they might pay me only 3.5 lakhs and ask me to wait for 3 days, right? So these are the important aspect. When it comes to life insurance, three important things here also. One is, of course, the last one is the claim history of the insurance company, again most important. But the other two very important is that how much insurance cover you should have. Correct? So by a thumb rule, it is said life insurance cover of any individual should be 10 to 20 times of their annual income. Which means if I have a 10 lakhs of income annually, I should buy a cover of roughly 1 crore to 2 crore, right? And as salary increases over a period of time, as my responsibility increases, I should buy additional insurance cover. Now, buying this insurance cover is also important because we tend to buy too many of such policies where insurance agents tells us that, sir, if you survive 20 years, you will get 10 lakhs, and if you die in these 20 years, you will get 5 lakhs. Now, that is one of the most useless product to buy for life protection, right? So for life protection, I should rather pay 10,000 rupees a premium and buy 1 crore of insurance cover. Now, for how long I should have the coverage, right? Why I have mentioned 65 to 70 is because in most cases, till the age of 65 or so, we will have our children still dependent on us. Maybe they are still working, but maybe I have to take care of their wedding and maybe some other responsibility, right? So plan it in that way so that you are covered at least till the time you think you might have some dependent, right? So that's all about financial planning. Now let's look at tax planning, right? Again, here also I'll not go very deep. I'll try to cover the two regimes which have come into picture from today, right? So let's look at old regime. So I'm only talking about personal income tax and not about somebody who might be in a business or something like that. So this is how so there are two tax slabs, as we all might have already known, correct? So quickly we'll look at this, how the tax slabs look like in old tax regime. So by the way, this is existing for a long time and there was no change even for the new financial year. So this has been there for a long time. So just for a reference, if somebody has 8 lakhs of salary, taxable income, he'll be paying 75,000 of taxes. And if somebody has 30 lakhs of income, he might be paying almost 7.5 lakhs of income tax. Correct? So this is how the slabs look like, and 4% cess applies on the total tax calculated. And there is a slight exemption for people in the senior citizen age group, 60 to 80 and 80 plus, where that 2.5 lakhs zero tax, actually that becomes 3 lakhs or 5 lakhs. Now let's look at new regime, because this is the most important one which all financial analysts are saying that is the way to go, right, for all of us. But we should understand if this is really the way to go for all of us. For some, of course, it is. Let's look at how the slab looks like in this case. Now, one thing is that this slab is same for all age groups. There is no additional benefit for senior citizen or super senior citizen. So this tax slabs has more slabs here, 5, 10, 15, 20 and 30, right? And you can see the example columns also. For 8 lakhs, if you are choosing new regime, your tax will be only 36, whereas in the previous case we saw, how much was that? 75,000, right? So in a basic technical terms, if you see, the taxes in the old regime will be higher in all the three categories, if you can see, right? And that is where our own analysis comes into picture. So we'll go deep in that. Now, income tax exemptions are available in old regime. So whatever two examples we saw previous two slides was considering that the person in old regime was not taking any exemptions, so the tax was higher. Now, there are certain exemptions available also in old regime. One is house rent. So house rent is tax exempted. If somebody is claiming LTA, that is tax exempted twice in 2 years or 4 years. Home loan, principal plus interest up to 2 lakhs is again exempted. ATC, we all know many of those are there, life insurance, PF, PPF, tax saving mutual fund and all that. There is a limit of 1.5 lakhs. Then NPS has two categories of exemptions. One is when I personally invest in my NPS account. Second is when my company invests in my NPS account. So both has additional benefit, right? But unfortunately, these two are also not well known by most of us. And the other one is medical insurance. So medical insurance is again exempted. For self, there is a limit of 25,000, self and our own family. And if I have parents, then the limit can go up to 50,000 rupees. And for a salaried class, whoever is drawing regular salary, for them additional 50,000 of flat exemption is allowed in old regime. And this one is allowed in new regime also. So these are so many things here. So if you collectively look at it, this exemptions can be in the range of anything between 4 to 5 lakhs rupees, right? Which means if you are able to take all the exemptions in different ways, you might save taxes on those 4 5 lakhs. What are the exemptions in new regime? Interesting part is that there is no exemptions as per new regime. However, there are two very specific ones other than standard deduction, which I already spoke about. One is when corporate contributes in my PF account or in my NPS account. Both the amounts are tax exempted, right? So PF, lot of us have by default, but corporate NPS does not come by default. This has to be chosen because it's voluntary. It has to be opted by salaried employee to get this benefit, and 10% of your basic can become tax exempt. Now let's take an example of how the tax calculation works out, okay? Because this will give you a clear picture. So I'm taking an example of a 30 years old who is 10 lakhs of income and his HRA benefit is 1.5 lakhs. Plus he is doing this kind of investment, right? So quickly have a look. And I've also mentioned what are the sections under which these exemptions come. Okay, so he is doing self PF, PPF, insurance, ELSS. So first two is ATC, complete 1.5 lakhs limits he is claiming. Health insurance he is claiming up to 35,000. However, 50 can be done. Self contribution 50 is maximum allowed. Corporate contribution 10% of basic is the maximum allowed. So he is doing all these investments. Now let's take a look when this person tries to analyze which regime to choose, right? So this is how it will look like. In old regime, standard deduction is there, HRA is tax exempted, plus all the investments which we saw in the previous slide, right? There were 5 of them, 2.8 lakhs. All 4.8 lakhs is now tax exempted, which means my taxable income has reduced from 10 lakhs to 5.2 lakhs. And my tax in case of old regime will be only 17,000. Right? If I choose new regime, I will get the benefit of standard deduction. I'll get the benefit of employer NPS, corporate NPS of 45,000, nothing else. So my taxable income in this case becomes 9 lakhs, 9.05 lakhs. And the tax comes out to be 47,000. So if you clearly see here, by utilizing the exemptions to a large extent, the taxability has gone down by 1/3. Right? Instead of 47, he is in 17. Correct? And if there was no exemption claimed by this person, his old regime tax might have been over 1 lakhs and new regime tax might have been 54,000. What does it tell us? Right? That by claiming exemptions in the best possible way, my tax liability can massively go down. Okay? So I'll just keep this slide for 2-3 minutes if you want to have a look. All right, so the question comes again, which I have actually already answered, that which one should I choose? Correct? And this is the choice you will have to make right now in the month of April, because all your company will open up tax declaration window for you. And in that tax declaration window, you will also have to tell which tax regime you want to choose, right? And to help you decide it, you should do the tax declaration properly so that you get to see which regime gives you lower tax, right? So there is no thumb rule, which one is better. One can be good for person A, second can be good for person B. It depends on how they invest in different things. If they have home loan, HRA, so many things as we talked about, right? So analyzing it with the right set of calculator is the best part. And good thing is that our next session is on this particular topic in 2 weeks from now, and we'll get very deep into all this analysis. Now, so we are done with the subject. Now, quickly, what Floater is, right? So, Floater is an application. In the beginning, I said, which is to create a. We have created a platform to manage personal finance for every individual, and these are the different areas which can be covered in a app if you log in. First is budgeting and expense tracking. So this covers our expense management. Second one, we talked about goal management, correct? So in the app, I can create financial goals. I can allocate which asset I want to invest in. Some of this can be done from the app itself, but there are few, like for example, PPF, right? PPF cannot be done through the app. That can be done through maybe your bank. But most of the other things, important things, are possible in the app only. And these are the stuff we have: mutual funds, NPS, gold investment can be done. And here it is digital gold, by the way. This is not a physical gold. This is digital gold, which I can buy at market price live 24/7, right? And I can buy and sell anytime. I can buy it as one time, I can buy it as monthly installment, regular. I can give a auto debit mandate, and I can have a SIP kind of a structure for gold. Equity investment can also be done, and we have one fixed deposit also from Bajaj Finance, right? Other than this, we talked about safeguarding the financial goal. And this is where life insurance and health insurance comes into picture. And in our app, you will only find life insurance which gives you death benefit, and not something which gives you maturity benefit in case of survival. Because the best product to buy in life insurance is life term insurance, which you can buy 1 crore of cover by paying 10 to 15,000 rupees depending on your age. Okay, coming to tax exemption focused products, these are four of them. NPS tier 1 investment is completely tax exempted up to 50,000 rupees. ELSS is a mutual fund where lock-in is 3 years. NPS lock-in is up to the age of 60. Term insurance, there is no lock-in as such, because here the benefits will come in case of death, right? Medical insurance for self and parents, both the things can be bought from the app. This is how the app looks like. It's a free to register app, and you can log in and utilize any of the product and features that is available and can be downloaded from Android as well as Google, iOS. And one can also follow our social media handles. We are across all the four popular media, and that will help you get to know about what's happening, when are we launching any webinars or any session, right? So that will be very helpful. Right, so we talked about an offer, right? So we have been talking about financial planning, personal finance, correct? So this is a new financial year, plus this is a first webinar session of this knowledge series for us. So there are two occasions from our perspective, and hence for all the attendees, this is the offer that we are rolling out, that you take one step towards financial wellness, and we offer you a free wellness plan, health wellness plan, right? Because both are important, because if health wellness is there, you will incur less cost on your healthcare expenses. All right, but before I roll out the offer, I am open for questions. Please, you can unmute yourself and ask. I hope I didn't rush through the topics. However, some of you might feel that extra attention was required in some of the topics. But looking at, as I said in the beginning, the overall idea of this presentation was that it opens up your thought process towards some of these very important uh, personal finance topics and concepts so that you start building upon that basic understanding. And of course, you can also come back for our future similar series of webinars to understand more about more deeper into some of the concept that we talked about today. But yeah, I mean, if you have any specific question on any of the topic which is more detailed, I can talk about it. Please. I hope no one is finding any issues in unmuting. Is
One
Just a minute,
one
भैया.
Yeah, please.
भैया, I have my age is 40 years. I have NPS, I have BPF account by company, some FDs, but there is no medical insurance uh, for after retirement. Then what should I do?
So, okay. So I think, uh, and this is a problem with a lot of private companies, employees also, and government employees, public sector, everywhere, because most of the places insurance cover is given during your working life. Now,
Yeah.
I told in the presentation in the relevant slide that I should also buy insurance on our own in addition to
Yes.
whatever company is giving. Now, why is that important, right? Let's understand that. When I go to
Yes.
buy a life insurance, my present health condition is considered before deciding how much insurance I can buy and how much cover I will get, whether I can buy for 5 lakhs or 20 lakhs, right? So for example,
Right.
in the age group of 40 to 50, right, many people these days in India are I mean, getting into diabetic problem or blood pressure and all that. Now these two are such medical condition which normally is a lifelong medical condition. And when we try to buy a health insurance after having these problems, then insurance company treat us as high risk individual, right? And
Yes.
from
Sure.
from day one itself they will charge us very high premium. Now other thing is that once we already cross the age of 60, chances are that we might have some other problems which is defined by the old age, right? And that time
Yeah.
it might happen that premium will be very high or I may not get a insurance. Hence it is important that we should buy some plan while we are still working, right? I
Yeah.
mean, I
Right.
always recommend buy even if you are 25-year-old today and your company is giving insurance, but at least people must buy by the age of 45, right? So that they buy something before they start facing some of those long-term medical conditions, because that only can keep renewing. Because after retirement, renewal is not a problem, and as per IRDA guidelines, insurance company cannot deny renewal till the lifetime. Even if
Yeah.
somebody is 100 years old, they have to renew
Yeah.
it. So better to buy it, and entering after 60 might be difficult in some cases.
Yeah. Right. And after retirement, I'm age of 40 years. I have 20 years left for service. Then I think for me, NPS is the best, is a good plan for me.
Yes, 20 years is very long. Obviously, NPS is the best because of two things. One is we get tax benefit when I'm investing. I mean, up
Yeah.
to 5,000 per month if I'm investing, that is tax exempted. Plus, best part is that even the maturity time it is tax free, which was because
Uh,
no other product gives that. Plus, the interest rate that comes here, right? Though it is not fixed, it has been giving 10 to 12% of interest rate.
I opened my NPS account in last 2 years. I think so, 2 years before. But how it can be linked with your floater application?
That has to be shifted to floater actually.
Yeah.
That requires some offline process. So I can help you later on with that.
Okay. Thank you.
So,
Yeah.
okay. On the medical insurance, I'll also add one more very important thing that nowadays there is something called top-up insurance. Okay, and
Yes.
that costs very less. That is very less expensive. And if somebody thinks that okay, I do not believe in paying 15,000 rupees for medical insurance because my company is already giving, then I will always request that at least buy a top-up insurance of 20 lakhs. This will not cost more than 10,000 rupees for a family of four. I'm talking about, right?
Okay.
And
Okay. Right.
what it will
Right.
do is that, so in top-up insurance, what happens? They will ask you what is the minimum insurance amount above which you want the insurance company to cover. So if your company is offering you 3 lakhs of insurance, please buy
Yeah.
a top-up insurance where your cover will start after 3 lakhs. So that
Okay.
up to 3 lakhs your company will pay, above 3 lakhs if something required, this insurance company will pay. So this super top-up policy is the best possible thing if somebody does not want to buy normal policy.
Okay. Right. Any other?
Yeah, any other person, please come forward. And I would say, even if you have known about certain topics and you have even slight clarification required on that, please come forward because it's very normal to have that kind of a scenario. Because many times we feel I know about it, but
Can you
slightly.
please send me the this PPT?
Uh, PPT we cannot share. Uh,
Especially for tax regime.
so for tax, we are coming up with the next session on 15th of April, and I'll talk about it after 5 minutes. What all will
Just
be covered in that?
15th of April. Okay. Right.
Yeah. That is again Saturday, same time we'll have.
Yeah.
So
Okay.
that will be completely dedicated to tax declaration, tax planning, old regime, new regime, where to invest, where do you get what benefits, all that.
Right.
Okay. Now, this is quickly about the upcoming session I talked about, right? This is a deep dive into personal taxation, income tax. Deep dive in the sense we will talk more in detail, and I think this is something which you should not miss if you have to plan for the next 12 months, right? Because as I said, this is the month your company will request you to do tax declaration plus choose the old regime, new regime, whatever you want, and it's important that you understand these topics. How to do tax declaration, right? So we'll talk a little bit about how the company expects it, right? And various tax exemptions that are applicable in both the tax regime, we'll talk about it. Then how to choose an investment from income tax exemptions point of view. So here we will not talk about investment which does not give tax exemption, because the overall idea for this session is to focus on tax exemptions, right? So we'll talk about, let's say there are 4 different types, then which one gives what kind of a benefit, you will get to know about it. And then obviously uh, we'll have a detailed FAQ where you can ask your specific question. So since now you know about what is the upcoming, maybe you could list down your questions before joining the next meeting. Invite is not yet out. You will receive email also. Plus, please follow us on YouTube, LinkedIn, Facebook, Instagram. Most of our webinars and all is posted on LinkedIn and Facebook. So if you are joining there, follow us. You will get to know for any announcements. Plus, we keep posting a lot of other, knowledge level of creatives and small topics. So you will be keeping track of that. All right, start.
Amit, Amit, I
Yeah,
have one small question, if it's okay now.
yeah.
Yeah, so you spoke about the corporate NPS, right? So is
Yes,
this above the 1.5 lakh ATC exception that we already have?
yes, Vijendra, it is. Okay, since you have asked, I'll quickly tell how the NPS works. So NPS is where, let's say you come to our mobile app right now, okay? And if you
Okay.
create a NPS account. So while opening the NPS account, you will have to choose individual or corporate. Correct? Now, you can choose corporate only if your company offers NPS. Right? What does it mean? Offers NPS means your company should be a registered NPS provider for employees. But otherwise, you can sign up as an individual and take the benefit of that 50,000. Now, if your company is also offering, then what you can do is that you can tell your company, please deduct 10% of my basic salary and deposit in my NPS account every month, similar to how they do for PF. Now, this full 10% of basic that is invested in NPS account comes under different section for exemption. Right? And this is why the case study which we saw, right, 45,000 of corporate NPS, and that was giving additional benefit out of that ATC and a lot of other categories that we know about. So, but yeah, for this you have to talk to your HR and probably connect us if you feel this is something you should have in your company. But you can still open your personal account, NPS. Now, if you already have a personal account, for example, and after 1 month your company also brings it, right? Then what you will do is that you will map your NPS account with the corporate model, and then you can start contributing through the corporate also.
Okay,
And good
for
thing
this
is that,
NPS, is there any lock-in period or anything? How does it work?
yes, Vijay, it is. It is. There is a lock-in period of actually 60 till the age of 60. So whenever you start till the age of 60, so maturity happens at the age of 60. However, there is a provision that if NPS account is 10 years old, then you can still close the account. Now, as you understand, NPS is a retirement planning solution, right? So the whole idea of creating that program by Government of India was to ensure financial security after retirement, right? Hence, all the 100% of the corpus cannot be withdrawn. 60% of the money can be withdrawn, and 40% of the money has to be converted into pension. And at that time, you can opt for any company to provide you pension. It can be LIC, SBI, HDFC, ICICI, anything. So that is up to the investor.
Okay,
So,
thank
but
you.
60% withdrawal which you will do, that will be zero long-term capital gain tax. There is no tax.
Okay, but always better to keep it till 60.
Yes, yes, always better. Because if you keep it till 60, then you can withdraw 60%. If you close before 60, then you can withdraw only 20%. And 80% has to be converted into pension.
Okay, good.
There are certain partial withdrawal provisioning also there. But I mean, for any very specific cases, I think 3 times throughout the life cycle of the NPS account you can withdraw also.
In fact, Vijendra, what we can do is we can also plan one dedicated session on NPS itself, just like we are planning personal taxation next week. Probably you can join that session to understand the complete story of NPS.
And by the way, if you go to our YouTube channel, I mean, just 4 days back, we have posted a 9 minutes video of NPS, which talks about the personal NPS. That does not talk about corporate NPS, but you can still go through it. So, except for the corporate tax benefit, it tells about everything.
Sure,
So
sure. Thank you.
Yeah.
Just for the audience, guys, if you guys have any topics in mind that you would like to hear it from us, please drop a note to us. We will come up with the content and we will present it here.